the company hidden in plain sight, the stock you probably use every day, without even knowing its name. How many of you have used an iPhone? How many own a Samsung phone? How many work on a Dell laptop? Or maybe your office recently upgraded to Microsoft servers, Apple Macs, or cloud services? Now here is the interesting question. What if I told you that one Indian company quietly stands somewhere behind millions of those products reaching businesses and consumers? Yet almost nobody outside the stock market talks about it. Not because it manufactures phones. Not because it designs laptops. Not because it owns Microsoft or Apple. But because it quietly connects all of them. And sometimes, the companies that build the bridges earn just as much respect from long-term investors as the companies building the castles. Welcome to another episode of Story Behind Stocks, where we don't just study companies. We uncover the business stories hiding behind stock prices. Most investors love exciting stories. Artificial intelligence, electric vehicles, defense, semiconductors, renewable energy. These words immediately create excitement. But here's a strange observation. History tells us that some of the biggest wealth creators were never the companies making the loudest headlines. Instead, they quietly became indispensable. Like the plumbing inside a skyscraper. Nobody notices it until it stops working. Today's company belongs to that category. A business that quietly powers the digital economy while remaining almost invisible. Its name, Redington Limited. Now before you think, oh, it's just another IT company, pause for a second. Because that assumption is exactly why many investors never spend time understanding this business. And investing often rewards people who are willing to understand what others casually ignore. There's a beautiful mental model used by Charlie Munger. He called it avoiding first conclusion bias. Our brain loves shortcuts. The moment we hear a familiar word, it labels the entire business. IT company, distributor, low-margin business. Nothing special. And then, the brain quietly closes the file. But successful investing begins exactly where most people's thinking ends. Instead of asking, what does this company do? A better question is, why does this company continue to exist after decades? Because businesses don't survive for 40 or 50 years by accident. They survive because they solve a problem that refuses to disappear. And that is exactly what we are going to discover today. Story behind stocks. Because every stock has a story. And every great investment begins by understanding that story. Imagine India tomorrow morning. Thousands of corporate offices switch on their computers. Hospitals activate diagnostic machines. Banks process digital transactions. Schools begin online classes. Retail stores update billing systems. Cloud servers exchange billions of pieces of information. Everywhere, technology quietly begins another working day. Now ask yourself, how did all those products reach these businesses? Someone had to move them, finance them, store them, support them, replace faulty equipment, provide spare parts, arrange logistics, manage warranties, deliver software licenses, coordinate with global brands. This invisible network is something most people never think about because it works so smoothly. And when something works smoothly, human beings stop noticing it. That is another fascinating psychological principle. We notice change. We rarely notice consistency. Great businesses often look boring because they quietly keep solving the same problem every single day. Now let me ask you another question. If tomorrow Apple wanted to enter a completely new country, would it rather build thousands of warehouses, hire thousands of logistics people, create financing teams, service centers, distribution channels, dealer relationships, credit systems, inventory management, and customer support from scratch? Or would it simply partner with someone who already spent decades building that entire ecosystem? Suddenly, the business starts looking different, doesn't it? This is another investing mental model, the toll bridge model. Imagine a bridge connecting to busy cities. The bridge doesn't manufacture cars. It doesn't manufacture trucks. It doesn't manufacture fuel. Yet, every vehicle crossing the river quietly pays the bridge owner. Now replace the river with global technology supply chains. Replace trucks with laptops, phones, servers, cloud infrastructure, enterprise software, consumer electronics, and industrial technology. Suddenly, you begin seeing why distribution businesses can become incredibly powerful. They become infrastructure, and infrastructure rarely makes headlines. But economies cannot function without it. Now here's where investing becomes interesting. Stock prices don't move because a company is famous. They move because expectations change. Sometimes investors ignore a company for years. Then one day, the business quietly starts improving. Earnings improve. Execution improves. Management delivers. Institutional investors slowly begin noticing. And finally, the market wakes up. Not because the company suddenly became good, but because people suddenly realized it had been good for much longer than they thought. That gap between business reality and market perception is where many successful investments are born. This is why experienced investors don't chase excitement. They chase improving businesses. Because the stock market is like a voting machine in the short run. People vote using emotions, excitement, fear, narratives. But over longer periods, it slowly transforms into a weighing machine. Eventually, profits, cash flows, capital allocation, management quality, and execution become impossible to ignore. And today's company seems to be entering exactly that fascinating phase where improving business performance is beginning to attract broader market attention. Story behind stocks. Because the biggest opportunities are often hiding in businesses everyone sees, but very few truly understand. But before we dive into financial statements, before we discuss profits, before we understand why institutions appear to be paying increasing attention, we first need to answer one simple question. What exactly does Redington do? Because once you understand the business, every number in the balance sheet starts telling a story. Every quarterly result begins making sense. Every market reaction becomes easier to understand. And most importantly, you stop looking at a stock ticker and start looking at a real business. So in the next chapter, we won't open Excel sheets. We won't start with pay ratios. Instead, we'll travel inside one of the world's largest technology supply chains to discover why a company that almost nobody talks about may actually be standing at the center of India's digital transformation. Before you move to the next chapter, I'd love to hear from you. As you follow this series, notice which parts make complex investing feel the simplest, and which parts you think could be explained even better. Share that in the comments. It helps shape future stories on this channel. Let's continue, because the real story of Redington is only just beginning. Chapter 03. The invisible moat. Why do some businesses survive for 30 years, while others disappear in 5? Have you ever wondered why one neighborhood grocery shop survives for 40 years, while another one opens with great excitement, offers discounts, spends heavily on advertising, and quietly shuts down within 3 years? After all, both shops sold the same products. Both had similar customers. Both wanted to make money. So what made one survive and the other disappear? The answer isn't luck. The answer is something investors call a competitive advantage. Now don't let that phrase scare you. Let's simplify it. Imagine two tea stalls. One is located on a lonely street. The other stands just outside a busy railway station where thousands of commuters pass every day. Both sell identical tea. Same taste, same price, same owner. But one has an advantage that the other cannot easily copy. That's a competitive advantage. In investing, people also call it a moat. And no, it has nothing to do with castles. Welcome back to Story Behind Stocks, where we don't just study companies. We uncover the business stories hiding behind stock prices. Imagine a medieval castle. Around the castle is a huge river. That river makes it difficult for enemies to attack. The wider the river, the safer the castle. Businesses also build invisible rivers, not with water, but with trust, relationships, technology, execution, brand, scale, distribution, customer loyalty. These invisible rivers protect profits. When Warren Buffett talks about buying wonderful businesses, this is exactly what he means. He isn't buying today's profits. He's buying tomorrow's protection. Now let's come back to Redington. Many investors see warehouse, boxes, computers, phones, servers, and they conclude, anyone can do this. That sounds logical. Until you ask one simple question. If anyone can do this, then why hasn't someone already replaced Redington? Think about it. For decades, global technology giants have trusted this company to move billions of rupees worth of products across multiple countries. That trust wasn't built by advertising. It was built by execution. Imagine you own Apple, or Microsoft, or Dell. Would you hand over products worth thousands of crores to someone with no track record? Of course not. Trust becomes the real product. And trust takes years to build. That is why experienced investors always ask, what exactly is difficult to copy? Charlie Munger had another beautiful idea. He called it a Lollapalooza effect. It simply means, when several small advantages come together, they become a very big advantage. Let's see how that works here. Suppose Redington has a strong warehouse network, thousands of dealers, long relationships with global brands, technology platforms, credit expertise, after-sales support, financing capability, and operational experience built over decades. Individually, none of these looks extraordinary. But together, they become extremely difficult to replicate. It's like cooking biryani. Rice alone isn't special. Neither are spices, nor vegetables, nor heat. But when everything comes together, the final dish becomes impossible to copy exactly. That is how moats are created. Not by one magical feature, but by many ordinary strengths working together. Now let me ask you another question. If you wanted to compete with Redington tomorrow, how much money would you need? Warehouse, technology systems, employees, supply chain software, finance teams, risk management, vendor approvals, thousands of dealer relationships, service infrastructure, credit assessment, inventory management, working capital, and perhaps most importantly, time. Years of time. This brings us to another investing concept. Barrier to entry. Think of opening a roadside tea stall. Almost anyone can do it. Now think about starting a commercial airline. Very different. Both are businesses. But one has far higher barriers to entry. Technology distribution isn't as easy as renting a warehouse. The real barrier lies in building an ecosystem where thousands of moving parts work together every single day without disruption. Now let's shift our attention to something investors often underestimate. Management. Imagine two cricket teams. Both have equally talented players. One team wins championships. The other struggles every season. Why? Leadership. The captain cannot score every run. But the captain decides strategy, culture, discipline, execution. Businesses work the same way. Management cannot personally deliver every laptop. They cannot visit every customer. But they create systems. And systems create results. This is why experienced investors often say, invest in management before you invest in numbers. Because numbers describe the past. Management shapes the future. One thing that stands out about Redington is continuity. The company has spent decades building its ecosystem instead of constantly reinventing itself. Even recently, the board reappointed its finance director for another 5-year term, signaling confidence in leadership continuity. The company highlighted his long experience in financial management, strategy, risk management, investor relations, and his role in Redington's growth since joining in 1998. Now, does that guarantee future success? No, nothing in investing is guaranteed. But continuity reduces uncertainty. Imagine boarding a flight. Would you feel more comfortable with a pilot flying that aircraft for 20 years? Or someone holding the controls for the very first time? Investors ask similar questions about businesses. Now let's discuss something that separates great companies from merely good companies. Capital allocation. Sounds complicated. Actually, it's one of the simplest ideas in investing. Imagine your family owns a small shop. Every year the shop earns 100 rupees. What should you do with that 100 rupees? Spend it? Save it? Open another shop? Buy better equipment? Reduce debt? Pay dividends? Every choice creates a different future. Companies make the same decisions. This is capital allocation. It's not about earning money. It's about what management does after earning it. Howard Marks often reminds investors that success isn't only about making good decisions. It's about making better decisions than everyone else. Great management teams know where every extra rupee creates the highest long-term return. Now here's something fascinating. Many investors become obsessed with quarterly profits. Professional investors often look somewhere else. They ask, is management thinking about the next 10 years? Or only the next 3 months? Businesses chasing quarterly applause sometimes sacrifice long-term value. Businesses building long-term value often disappoint impatient investors for short periods. This is where patience becomes an investment advantage. Peter Lynch once joked that far more money has been lost preparing for corrections than in corrections themselves. The same applies to businesses. Great businesses are rarely perfect every quarter. They simply keep moving in the right direction over many years. Story behind stocks. Because great investing isn't about predicting tomorrow. It's about recognizing businesses that keep getting stronger year after year. Now, there's another question every investor should ask. If this company looks so stable, why doesn't everyone own it? Why wasn't it always among the market's favorite stocks? Because the stock market has an interesting habit. It often notices improvement only after the improvement has already begun. Businesses usually change first. Numbers improve later. Stock prices react after that. And public attention often comes last. Understanding that sequence is one of the biggest advantages an investor can develop. In the next chapter, we'll open the financial statements. But don't worry, there won't be accounting lectures. Instead, we'll treat every number like a clue in a detective story. Why did revenue suddenly accelerate? Why are profits growing faster than sales? What changed inside the business? Are these temporary improvements or signs of a stronger company emerging? Because numbers by themselves never tell the whole story. But when you connect them with the business, they begin to speak. Before we move to the next chapter, I'd love your thoughts. As you're following this journey, which chapter has stayed with you the most so far? And if there's a place where the storytelling could become even clearer or more engaging, let me know in the comments. Your suggestions help shape the next stories we tell together. Chapter 04. When numbers start telling a story, a financial statement is like a medical report. If you know what to look for, let me ask you something. Imagine two people walk into a hospital for a routine health checkup. Both look perfectly healthy. Both are smiling. Both say they feel absolutely fine. But after running a few medical tests, the doctor tells one person, "You're getting healthier every year," and tells the other, "You look healthy from the outside." But several warning signs are slowly developing inside. From the outside, both people looked exactly the same. The difference only became visible after looking beneath the surface. Businesses are no different. A rising stock price tells you what the market feels today. A financial statement tells you what the business is actually becoming. And just like a doctor never judges health from a person's smile alone, a serious investor never judges a company from its stock price alone. Welcome back to Story Behind Stocks, where we don't just study companies. We uncover the business stories hiding behind stock prices. Today, We're not going to read balance sheets like accountants. We're going to read them like detectives. Every number is a clue. Every change tells a story. And sometimes, the most important story isn't the number itself. It's how the number is changing. Because investing isn't about finding perfect companies. It's about finding companies that are becoming better. Imagine you own a small grocery store. Last year, 100 customers visited your shop every day. This year, 150 customers are coming. Is that good? Of course. But now imagine something even better. Not only are more customers visiting, they're also buying more products each time they visit. Now your profits grow even faster than your sales. That's exactly the kind of improvement investors love to see. And something very similar is happening inside Redington. Let's begin with revenue. Revenue simply means the total business generated before expenses. Think of it as the total amount collected at the billing counter. If your grocery shop sold goods worth 10 lakh rupees today, that's your revenue. It doesn't mean you earned 10 lakh rupees. It simply means that's how much business passed through your shop. Now here's where the story becomes interesting. Redington's revenue didn't just increase. It accelerated. Compared with the same quarter last year, standalone revenue rose from about 12,757 crore rupees to 20,753 crore rupees. Now think about that. Technology demand didn't simply remain stable. The company's ability to execute also improved. Because revenue growth of this scale doesn't happen because someone gets lucky for 3 months. It usually reflects stronger customer relationships, better execution, or a larger opportunity being captured. But here's where experienced investors become cautious. Growing revenue is good. Growing profitable revenue is even better. Because any company can increase sales by selling products cheaply. Imagine opening a restaurant. If you sell every meal below cost, your restaurant will be packed. But eventually, you'll go bankrupt. Sales without profits are simply expensive popularity. This is why smart investors never stop at revenue. They immediately move to profits. Now look at Redington's profits. They also increased. But here's the fascinating part. Profits grew faster than revenue. That tells us something important. Imagine your salary increases by 10%, but your savings increase by 30%. What happened? You probably became more efficient with your spending. Businesses work exactly the same way. When profits grow faster than sales, it often means the company is executing better. Its systems are improving. Its operations are becoming more efficient, or its business mix is becoming healthier. Redington's standalone profit after tax increased from around 200 crore rupees in the June 2025 quarter to about 321 crore rupees in the June 2026 quarter. This is exactly the type of trend long-term investors like to see. Not perfection, improvement. Now let me introduce another investing idea. It's called operating leverage. Sounds complicated. Actually, it's something all of us experience. Suppose you rent a wedding hall. Whether 100 guests attend or 300 guests attend, the rent remains almost the same. Now imagine 3 times as many guests arrive. Your costs don't increase at the same speed. Your profits improve much faster. Businesses experience the same phenomenon. When a company already has infrastructure, warehouse, technology, people, and systems, every additional rupee of revenue can sometimes produce disproportionately higher profits. It's like pushing a heavy flywheel. The first few turns require enormous effort. But once momentum builds, the wheel begins turning almost by itself. Charlie Munger loved this mental model. Great businesses often resemble flywheels. Slow at first, powerful later. Now let's talk about something most new investors completely ignore. Earnings per share, or EPS. Think of a family owning a bakery. If the bakery earns 100 rupees, and there are 10 family members, each person's share is 10 rupees. Now imagine the bakery earns 150 rupees next year. without increasing the number of owners. Everyone's share automatically becomes larger. EPS simply tells you how much profit belongs to each shareholder. Redington's EPS improved from 2.56 to 4.11 over the same year. That may look like a small number, but it tells a powerful story. Every share now represents a larger slice of the company's earnings. And that's exactly what shareholders want. Now, before we become too optimistic, let's remember something Howard Marks often reminds investors. Every business has strengths. Every business has risks. The goal isn't to find companies with no weaknesses. Those don't exist. The goal is to understand whether the strengths are improving faster than the risks. So, what changed that deserves attention? One noticeable change is finance costs. Think of running a wholesale shop. As your business grows, you often need more working capital, more inventory, more receivables. Sometimes that means borrowing more money for day-to-day operations. During the latest period, finance costs increased compared with the same quarter last year. Should investors panic? Not necessarily. The important question isn't whether borrowing increased. It's whether profits are growing faster than financing costs. So far, that appears to be the case. But it's certainly something worth monitoring every quarter. Employee expenses also increased. Now, many people immediately think, higher costs are bad. Not always. Imagine your own business doubles in size. You'll probably hire more employees, better managers, better engineers, better sales teams. Higher employee expenses can actually signal expansion, provided productivity improves alongside it. Numbers always need context. Now let's discuss one of the most misunderstood ideas in investing. Cash, profit, and cash are cousins, not twins. Imagine you sell your car today. The buyer promises to pay you after 6 months. Technically, you've made the sale, but you haven't received the money yet. Distribution businesses like Redington constantly manage inventory, customer credit, supplier payments, and receivables. That's why experienced investors closely watch working capital. Not because it's exciting, but because it tells us whether growth is healthy or becoming financially stressful. This is one area investors should continue tracking over future quarters. Now here's another clue. The company's retained earnings, or shareholders' equity, continued to grow. Think of planting a mango tree every year instead of cutting branches. The tree becomes thicker, stronger, more capable of producing fruit. Growing equity often reflects that the business is retaining and compounding value over time, with standalone other equity increasing between FY 2025 and FY 2026. Compounding rarely looks dramatic in 1 year. Its magic becomes visible over many years. Now let's connect everything. Revenue improved, profits improved, earnings per share improved, profit before tax improved. The balance sheet strengthened. Management continued rewarding shareholders through dividends while maintaining leadership continuity. At the same time, finance costs increased. Employee costs increased. Working capital remains an area to monitor because that's the nature of this business. Do these negatives outweigh the positives? Based on the information we've discussed? Not yet. In fact, the positives currently appear to be strengthening faster than the challenges. And that's exactly what investors hope to see. Not a perfect company. A company becoming stronger. Story behind stocks. Because great investing isn't about finding flawless businesses. It's about recognizing businesses whose future is improving faster than their past. But here's the question that naturally follows. If the business is improving, is the stock still reasonably priced? Or has the market already recognized all this progress? Because even the world's best company can become a poor investment if you pay far too much for it. In the next chapter, we leave accounting behind and step into one of the most misunderstood areas of investing: valuation. We'll answer questions like, why do some expensive-looking stocks become multi-baggers? Why do some cheap-looking stocks remain cheap forever? How do professional investors think about value versus quality? And why does buying a wonderful business at a reasonable price often create better long-term outcomes than buying an average business simply because it looks cheap? Before we continue, here's something I'd genuinely like to know. As you're following this story, which chapter has made you pause and think differently about investing? And if there's any part where the explanation could be even clearer or more relatable, share it in the comments. Your perspective helps shape every future story we bring to this channel. Chapter 05: Price versus Value. Why a 100 rupee note is sometimes worth 80 rupees and sometimes worth 500 rupees. Let me begin with a simple question. Imagine I place two houses in front of you. The first house costs 50 lakh rupees. The second costs 1 crore rupees. Without seeing either property, which one is cheaper? Most people immediately answer, the 50 lakh rupees house. But what if I now tell you, the 50 lakh rupees house has leaking walls, old wiring, water shortages, and is located in an area where nobody wants to live, while the 1 crore rupees house sits in a fast-growing neighborhood, has excellent construction, steady rental income, and the surrounding land keeps appreciating every year. Now tell me, which one is actually cheaper? Suddenly, the answer changes, because investing teaches us one of the most important lessons in finance. Price is what you pay. Value is what you receive. Those two words sound similar, but they are worlds apart. Welcome back to Story Behind Stocks, where we don't just study companies. We uncover the business stories hiding behind stock prices. One of Warren Buffett's most famous ideas is surprisingly simple. It's far better to buy a wonderful business at a fair price than a fair business at a wonderful price. Think about that. Many beginners spend their lives searching for the cheapest stocks. Professional investors spend their lives searching for the best businesses. Because cheap companies don't always become expensive, but quality companies often become more valuable over time. The market may ignore them for months, sometimes years. Eventually, earnings begin speaking louder than opinions. Now here's a fascinating psychological trap. Imagine two mobile phones. One costs 8,000 rupees. The other costs 80,000 rupees. Many people immediately assume the cheaper phone is the better deal. But what if the expensive phone lasts twice as long, works faster, retains resale value, and saves hours of productivity every week? Was it really expensive? Or was it simply higher quality? Businesses work exactly the same way. Investors often confuse cheap-looking stocks with good investments. They're not the same thing. Let's connect this idea with Redington. For years, many investors looked at the company and thought, it's just a distributor, low margins, not glamorous, nothing exciting. And because of that perception, the company rarely received the kind of excitement that fashionable sectors enjoy. Meanwhile, the business quietly continued building relationships, expanding operations, improving execution, and strengthening its financial performance. Sometimes, the market's biggest mistake isn't overestimating a company. It's underestimating a business simply because it appears ordinary. This brings us to our first valuation model, price-to-earnings ratio, or PE. The term sounds intimidating, but imagine buying a shop. The shop earns 10 lakh rupees every year. The owner asks 1 crore rupees. You're effectively paying 10 years of annual earnings to own that business. That's exactly what the PE ratio tries to measure. How much are investors paying for every rupee of profit? Now here's the mistake many beginners make. They believe lower PE automatically means cheaper. Not necessarily. Imagine two mango trees. One grows 5 mangoes every year. The other grows 50 and produces more every season. Would you pay the same price for both? Of course not. A faster-growing business deserves a higher valuation than a stagnant one. That's why PE without growth tells only half the story. Which brings us to another important concept, PEG ratio. Think of PE as the price tag. Think of earnings growth as the engine. PEG simply asks, am I paying a reasonable price for this growth? Imagine buying two cars. One costs 10 lakh rupees. The other 12 lakh rupees. But the second gives twice the mileage, needs fewer repairs, and lasts much longer. Looking only at price would mislead you. PEG attempts to connect price with growth. And when a company combines reasonable valuation with improving earnings, many experienced investors become interested. Now let's discuss something called discounted cash flow, or DCF. This sounds like something only investment bankers understand. Actually, you've been using the same logic your whole life. Suppose someone tells you, I'll give you 1 lakh rupees today. Oh, I'll give you 1 lakh rupees after 10 years. Which would you choose? Obviously today. Because money available today can be invested and grow. DCF simply brings future money back into today's value. It asks, if this company keeps generating cash for many years, what is all that future cash worth today? It's like calculating the present value of tomorrow's harvest. But here's something interesting. DCF is incredibly useful, yet it's also incredibly sensitive. A tiny change in growth assumptions, interest rates, or margins can dramatically change the answer. That's why great investors don't worship DCF. They use it as a compass, not a crystal ball. Now let me introduce another fascinating idea. Reverse DCF. Instead of asking, what is this company worth? Reverse DCF asks, what future is the market already expecting? Imagine a student scores 98 marks. Some parents expect 99 next year. Others expect 100. Some expect perfection forever. At some point, expectations become impossible to satisfy. Stocks behave similarly. Sometimes, a company doesn't disappoint. Expectations simply become unrealistic. Reverse DCF reminds investors to ask, how much future success is already built into today's price? That's a much smarter question. Now let's move to another popular valuation method, EV to EBITDA. The name sounds frightening. Let's simplify it. Suppose you're buying a restaurant. Would you only pay for the furniture? No. You'd also consider loans, cash, kitchen equipment, brand, and ongoing business. Enterprise value attempts to capture the total cost of buying the entire business. EBITDA approximates the operating earnings generated before financing and accounting adjustments. Together, EV/EBITDA helps investors compare businesses with different debt structures. It's particularly useful when comparing companies within the same industry. Now comes one of my favorite investing ideas, margin of safety. Imagine you're driving across a bridge. Would you feel safer if the bridge could carry exactly 5 tons? Or 20 tons? That's the margin of safety. Benjamin Graham believed investing should always leave room for mistakes. Because no investor, no analyst, no management team can predict the future perfectly. Buying without a margin of safety is like walking a tightrope without a net. Now let's talk about something that has quietly become one of the most successful investment styles over the last 2 decades. Value meets quality. Years ago, investors often divided themselves into 2 camps. The value investors bought cheap companies. The quality investors bought wonderful businesses. Today, many experienced investors try to combine both worlds. Instead of asking, is this stock cheap? They ask, is this business becoming better? While still being reasonably valued? That small shift changes everything. Because the biggest winners are often companies where the business keeps improving, earnings continue growing, institutional interest quietly increases, market confidence gradually strengthens, and the valuation still leaves room for future appreciation. Notice something interesting about Redington's recent story. Its financial performance has strengthened. Profits have improved. Earnings per share have grown. The business appears to be executing well. At the same time, its growing visibility across multiple independent stock selection frameworks suggests that different analytical approaches are beginning to notice the same improving characteristics. No single screener proves anything. But when different methods arrive at similar conclusions, it's often worth asking, what are they all seeing? That's a much more powerful question than blindly following any one model. Now let me share another mental model. Imagine watching a cricket match. One player scores a century. Wonderful. But what if he has scored centuries every season for the last 10 years? Now you're no longer looking at talent. You're looking at consistency. Markets pay premium valuations for consistency because consistency reduces uncertainty. And uncertainty is what investors truly fear. Howard Marks often says, risk doesn't come from buying quality businesses. Risk comes from paying foolish prices. Likewise, buying an average company simply because it's cheap can become one of the most expensive mistakes an investor ever makes. Story behind stocks. Because successful investing isn't about finding the cheapest stock. It's about discovering quality businesses before everyone agrees they're quality. Now, we've understood the business. We've understood management. We've understood the financial statements. We've understood valuation. But one fascinating question still remains. If the fundamentals are quietly improving, why does the stock chart suddenly begin changing? Can a price chart actually reveal something about human psychology? Can buying and selling patterns tell us how institutions think? Can charts become a window into crowd behavior, rather than merely lines on a screen? In the next chapter, we'll discover why technical analysis isn't really about predicting prices. It's about understanding people. Because behind every candle, every volume spike, every trend, and every breakout, there is one thing markets never stop reflecting: human behavior. Before we move into that world, I'd love to hear your perspective. As this journey unfolds, which chapter has added the most value to the way you think about investing? And if there's a concept you'd like explained through an even simpler story, tell me in the comments. Your ideas help make every future episode better for the entire story behind stocks community. Chapter 6. Chapter 06. The language of the market. A stock chart doesn't predict the future. It reveals what millions of people are thinking today. Let me ask you a question. Imagine you're standing outside a shopping mall on a Sunday evening, without entering the mall, without asking anyone, without seeing a single sales report. Could you still guess whether business inside is booming? Of course. If the parking lot is overflowing, families are walking in with shopping bags, restaurants have waiting lines, and people are patiently standing in queues. You don't need to see the accounts. Human behavior has already told you something. Now imagine the opposite. An empty parking lot, silent corridors, closed counters, no customers. Again, you haven't looked at a single financial statement. Yet you've learned something important. This is exactly how technical analysis should be understood. It isn't magic. It isn't fortune telling. It isn't predicting tomorrow. It is simply observing human behavior through price and volume. Welcome back to Story Behind Stocks, where we don't just study companies. We uncover the business stories hiding behind stock prices. One of the biggest misunderstandings in investing is this. People believe charts predict the future. They don't. Charts record decisions. Every point on a chart represents thousands, sometimes millions, of decisions made by buyers and sellers. Behind every green candle, someone believed the company deserved a higher value. Behind every red candle, someone decided to sell. The chart isn't speaking. People are. And learning technical analysis is simply learning how to listen. Imagine attending a cricket match. You don't know the score. You can't see the scoreboard. But suddenly, the crowd erupts. People stand up. Flags begin waving. Players celebrate. Without seeing the scoreboard, you already know something important has happened. Price behaves the same way. Sometimes, before the news becomes obvious to everyone, the behavior of market participants begins changing. Not because they know the future, but because they are reacting to information differently. The chart captures that collective reaction. Now here's an interesting mental model. Imagine a school examination. Every student studies the same textbook, but not everyone scores the same marks. Why? Because knowledge is one thing, execution is another. The stock market works exactly the same way. Thousands of investors read the same annual report, the same quarterly results, the same news. Yet some buy, some sell, some wait. The chart is nothing more than the final report card of all those decisions. Let's simplify another term that scares many beginners. Trend. People often imagine complicated mathematical formulas. Actually, you've understood trends since childhood. Suppose every year your neighborhood becomes cleaner. New parks appear. Roads improve. Schools open. Restaurants increase. Property prices gradually rise. You naturally conclude, this area is improving. You don't need a graph. You simply observe a pattern. A trend is nothing more than a pattern that keeps repeating. In businesses, improving profits create trends. In markets, improving expectations create trends. The two don't always move together immediately, but over long periods, they usually find each other. Now think about climbing a mountain. Nobody reaches the top in one giant leap. You climb, pause, catch your breath, then continue. Strong businesses often behave similarly in the stock market. They move higher, they rest, they absorb new investors. Then, if the business continues improving, they resume their journey. Many beginners panic during those resting phases. Experienced investors often see them differently. They ask, has the business changed, or has the market simply paused? That single question can completely change your investing behavior. Now let's talk about something called volume. Forget the complicated definition. Imagine two restaurants. The first restaurant has one customer praising the food. The second has a queue stretching outside the building. Which recommendation would you trust more? Exactly. Crowds don't guarantee quality, but they tell you interest is increasing. Volume plays a similar role in markets. Price tells us what happened. Volume tells us how many people participated. When both begin moving together, professional investors pay attention. Not because it guarantees success, but because participation itself contains information. In Redington's case, the chart we discussed earlier wasn't just showing a rising price. It was also showing stronger participation alongside that move. That combination often suggests growing conviction among market participants rather than a move driven by only a handful of traders. This is an observation of market behavior, not a prediction of what must happen next. Now let me introduce one of my favorite mental models. Imagine a theater. The movie has just started. Most seats are empty. A few people quietly walk in. Nobody notices. 20 minutes later, more people arrive. Soon, half the theater is full. Then suddenly, everyone outside notices the blockbuster. Long queues appear. Tickets become difficult to get. Now ask yourself, who got the better seats? The people who quietly entered early, or those who joined after hearing everyone else talking? Markets often behave the same way. Large institutions rarely buy everything in one day. If they did, they would push prices sharply higher against themselves. Instead, they often accumulate patiently, gradually, quietly, like filling a large water tank using a slow pipe. From the outside, nothing dramatic seems to happen, until one day, the market suddenly notices. This idea is often called institutional accumulation. Think of it as a library slowly adding books to its shelves. One book doesn't change much. Thousands of books eventually create a world-class library. Similarly, steady accumulation over time can gradually shift the balance between supply and demand. No one can know every buyer's identity from a chart. But when improving business performance and improving market participation begin moving together, it's reasonable to ask whether larger investors are becoming more interested. Now let's discuss another concept that confuses many investors. Momentum. Momentum sounds like speed, But it's really about persistence. Imagine pushing a bicycle. The hardest part is the first few meters. Once it starts moving, keeping it moving becomes easier. Businesses experience momentum. Profits improve. Confidence improves. Customers increase. Investors notice. Analysts update estimates. Institutions become interested. The cycle begins feeding itself. George Soros called something similar reflexivity. It simply means sometimes perception changes reality. When a company earns investor confidence, it may find it easier to raise capital, hire better talent, expand faster, negotiate better with partners. Positive perception, when backed by genuine business improvement, can reinforce future success. Notice the important condition. It must be backed by genuine business improvement. Otherwise, it's merely speculation wearing expensive clothes. Now let's talk about something every investor experiences. Fear of missing out. Imagine your neighbor buys a flat. 6 months later, its value increases. Another neighbor buys. Then another. Soon, everyone believes property prices can only go up. People stop asking, is this a good investment? Instead they ask, what if I miss it? That emotional switch is dangerous. Markets amplify emotions. Greed, fear, hope, regret. Technical analysis helps investors observe these emotions without becoming controlled by them. It encourages a different question. What is the market doing? Instead of, how am I feeling? That small difference often separates discipline from impulse. Now here's another mental model. Imagine driving on a highway at night. Your headlights don't illuminate the entire journey. They only reveal the next few hundred meters. Yet, that's enough to safely reach your destination. Charts work the same way. They don't reveal the next 5 years. They simply reveal where the market's current behavior is pointing. Fundamentals tell you what to buy. Technical analysis often helps answer when the market is beginning to agree with your thesis. Neither is complete without the other. Think of fundamentals as the engine of a car. Think of technicals as the dashboard. A powerful engine without a dashboard leaves you unaware of speed, fuel, or direction. A dashboard without an engine takes you nowhere. Successful investing combines both. Now let's connect everything we've learned about Redington. We discovered a business benefiting from long-term technology adoption. We saw improving financial performance. We understood management continuity. We explored why the company appears to be strengthening operationally. Then we looked at the market's behavior. Instead of contradicting that business story, the chart appeared to reinforce it. The market wasn't guaranteeing future success. Markets never do. But the improving business narrative and improving market participation seem to be telling a similar story. When two independent sources begin pointing in the same direction, experienced investors don't celebrate. They become curious. Curiosity is far more valuable than excitement. Story behind stocks. Because the smartest investors don't choose between fundamentals and technicals. They let each one challenge, confirm, and strengthen the other. But even after understanding the business, the financials, the valuation, and the psychology of the market, one important question still remains. Why did this company begin appearing repeatedly across different investment frameworks that look for entirely different characteristics? What are these independent methods quietly discovering? Is it just coincidence? Or are they all detecting the same underlying improvement from different angles? In the next chapter, we'll connect every piece of the puzzle, not by following any single stock selection formula, but by understanding why different ways of looking at the market sometimes arrive at the same conclusion. And when that happens, the story often becomes much more interesting. Before we move into the final stretch of this journey, I'd love to hear your thoughts. Which chapter has stayed with you the longest? And if there's a place where the storytelling could become even simpler or more engaging, let me know in the comments. Your feedback helps make every story behind stocks episode stronger for everyone who watches. Chapter 07. when different roads lead to the same destination? What if completely different investors quietly start looking at the same company? Let me ask you something. Imagine you're searching for the best restaurant in a new city. The first person recommends one restaurant. You think, maybe it's just personal preference. Then your taxi driver recommends the same place. Later, your hotel receptionist mentions exactly the same restaurant. Finally, a local family tells you, if you really want authentic food, that's where you should go. Now pause for a second. None of these people know each other. None planned their recommendation together. Yet, they all arrived at the same conclusion. Wouldn't that make you curious? Not convinced. Curious. Because curiosity is where intelligent investing begins. Welcome back to Story Behind Stocks, where we don't just study companies. We uncover the business stories hiding behind stock prices. One of the biggest myths in investing is that there is only one way to find a good company. Nothing could be further from the truth. Imagine 5 doctors examining the same patient. A cardiologist studies the heart. A neurologist studies the brain. An orthopedic surgeon studies the bones. A nutritionist studies eating habits. A physiotherapist studies movement. Each doctor focuses on something completely different. Yet, if all 5 independently conclude, this person's health is improving, that conclusion becomes much stronger than a single opinion. The stock market works exactly the same way. Every investor looks through a different window. Some study earnings. Some study cash flow. Some study valuation. Some observe management. Some watch market behavior. Some analyze business quality. Each method asks different questions. Yet sometimes, they quietly begin pointing toward the same company. And that is when experienced investors stop asking, should I buy? Instead they ask, what are all these different approaches seeing that I haven't fully understood yet? Charlie Munger once said, invert, always invert. Instead of asking, why should I buy this company? Ask the opposite. Why would completely different investors become interested in the same business? The answer is rarely one magical reason. It is usually the combination of many small improvements happening at the same time. Imagine preparing a cup of tea. The water is important. The tea leaves are important. Milk matters. Sugar matters. Temperature matters. Time matters. Remove any one ingredient, and the final taste changes. Investing works exactly the same way. Great opportunities rarely appear because one metric looks attractive. They emerge when several independent factors quietly begin improving together. Now think back to everything we've discovered so far. We started with the business itself. A company that doesn't manufacture technology, but enables technology to reach millions of customers. A business quietly standing behind some of the world's biggest technology brands. Then we looked at the industry. A world becoming more digital every year. Businesses adopting cloud computing. Artificial intelligence becoming part of everyday work. Schools, hospitals, banks, factories, governments, all demanding more technology infrastructure. The wine behind the industry continues blowing. That alone doesn't guarantee success, but it certainly creates opportunity. Then we studied management, not through speeches, not through advertisements, but through execution. A leadership team that has focused on building systems, relationships, and continuity over decades. Because trust cannot be purchased. It has to be earned. Especially when global brands entrust billions of rupees worth of products to your ecosystem. Then we opened the financial statements. The numbers told a story. Business activity increased. Profits strengthened. Shareholder earnings improved. The company continued to generate stronger operating performance while maintaining continuity in leadership and returning value to shareholders through dividends. Were there challenges? Of course. Higher finance costs. Higher employee expenses. Working capital that always needs careful management. But remember something important. Professional investors rarely ask, is this company perfect? They ask, are the strengths improving faster than the weaknesses? That question changes everything. Then we discussed valuation. Not through complicated formulas, but through common sense. A wonderful house isn't expensive simply because it costs more. A poor quality house isn't cheap simply because it costs less. Quality always deserves context. The same applies to businesses. A company combining improving earnings with a reasonable valuation often deserves far more attention than a company that merely appears statistically cheap. That's the difference between buying a bargain and buying value. Finally, we looked at the chart, not as fortune tellers, but as students of human behavior. We saw something interesting. The business story appeared to be improving, and market behavior appeared to be acknowledging that improvement. Not perfectly, not dramatically, but gradually. Almost like dawn. Nobody notices sunrise at the exact second it begins. Only later do people realize. The darkness had already started disappearing. Now here's where the story becomes fascinating. Imagine 5 treasure hunters. One uses a metal detector. Another studies old maps. One interviews local villagers. Another studies satellite images. A fifth examines historical records. Each follows a completely different process. Now imagine, all 5 independently arrive at the same location. Would you immediately start digging? Probably not. But you'd certainly become interested in that location. Markets behave similarly. Different investment frameworks often search for completely different characteristics. Some focus on improving businesses. Some look for financial strength. Others look for changes in market behavior. Others look for consistency. Occasionally, those independent approaches begin overlapping, not because they copied one another, but because the company itself has started exhibiting multiple positive characteristics at the same time. That's one reason Redington has increasingly attracted attention across different analytical approaches in recent months. The important lesson isn't to follow those approaches blindly. It's to ask, why are different methods noticing the same business? That question develops judgment. Blindly copying never does. This brings us to one of the most powerful mental models in investing, the mosaic theory. Imagine trying to solve a 1,000-piece jigsaw puzzle. One piece tells you almost nothing. 2 pieces reveal very little. But as more pieces connect, the picture slowly emerges. No single piece explains everything. Revenue alone doesn't. Profit alone doesn't. Management alone doesn't. Valuation alone doesn't. Charts alone don't. But together, they begin telling one coherent story. Professional investors don't rely on one indicator. They build a mosaic, one tile at a time. And when enough independent pieces begin fitting together, confidence naturally increases. Not certainty, confidence. Because certainty doesn't exist in investing. Howard Marks often reminds investors that successful investing isn't about being right all the time. It's about being more right than wrong over long periods. That sounds surprisingly ordinary. Yet it contains enormous wisdom. Markets don't reward perfection. They reward probabilities. Think of a skilled cricket captain. He cannot predict every ball. He simply places fielders where the probability of success is highest. Investing works exactly the same way. You aren't trying to eliminate uncertainty. You're trying to improve the odds. Now let me share another mental model. Imagine you're assembling a world-class cricket team. Would you select players based only on batting? Of course not. You also need bowlers, fielders, a wicket-keeper, leadership, fitness, team chemistry. Championship teams are built through balance. Great investments are remarkably similar. Business quality, management quality, financial improvement, reasonable valuation, positive market behavior, long-term industry growth. When several of these trends begin working together, the investment thesis becomes stronger than any single factor on its own. Now, does all this guarantee success? Absolutely not. And anyone who promises certainty in the stock market is selling confidence, not wisdom. Unexpected regulations can emerge. Technology can evolve faster than expected. Competition can intensify. Economic cycles can slow demand. Execution can weaken. Every investment carries risk. The goal isn't to eliminate risk. The goal is to understand whether the potential reward appears proportional to the risks being taken. That mindset separates investing from gambling. Story behind stocks. Because the best investment ideas are rarely built on one brilliant insight. They are built on many ordinary insights quietly agreeing with one another. Now we have almost completed our journey. We understand the business, the industry, the management, the financial story, the valuation, the psychology behind the chart, and how different analytical perspectives can sometimes converge on the same company. Only one chapter remains. Not about numbers, not about charts, not about formulas. Instead, we'll answer the question every investor eventually asks. What kind of investor is this company really suitable for? Who should simply keep it on a watch list? Who might consider studying it more deeply? Who should probably stay away? Most importantly, what lessons does Redington teach us that can help us become better investors, even if we never buy a single share? Because the greatest investment isn't always the stock you purchase. Sometimes, instead of asking, "Why should I buy this company?" ask, "What could make this investment fail?" That single habit separates an investor from a cheerleader, because markets don't reward optimism. Markets reward realism. Throughout this journey, Redington has looked like a business quietly becoming stronger. The industry has long-term opportunities. The financial performance has improved. Management appears stable. The market has started paying greater attention. But now, let's deliberately become uncomfortable. Let's imagine we're trying to prove ourselves wrong. Because the smartest investors aren't trying to confirm their opinions. They're trying to challenge them. Let's begin with the biggest reality of this business. Margins. Now don't worry about the technical word. Imagine you own a grocery shop. Customers come all day. Sales are huge. Trucks unload products every morning. Shelves are always full. The billing counter never stops. Sounds fantastic. But at the end of the month, after paying rent, staff, electricity, transport, and suppliers, you discover that only a very small portion of those sales actually becomes your profit. That's exactly how many distribution businesses operate. The business handles enormous volumes, but every rupee earned has to be fought for. This isn't a weakness unique to Redington. It's the nature of the industry. Think of airlines. Millions of passengers travel every year, yet profitability remains difficult. Volume alone doesn't guarantee extraordinary profits. Execution does, which means management has very little room for mistakes. Now imagine running that grocery shop. You purchase goods today, but your customers promise to pay after 60 days. Meanwhile, your suppliers expect payment much earlier. Suddenly, your money becomes trapped in the middle. This is called working capital. Again, don't let the term sound complicated. Imagine filling a bucket with water. If water enters slowly, but leaves quickly, the bucket empties. If water leaves slowly, but enters quickly, the bucket overflows. A business constantly manages this flow of money. Distribution companies naturally require significant working capital because products keep moving through the supply chain before cash fully returns. It's like the bloodstream of the business. As long as blood keeps circulating, the body remains healthy. If circulation slows, problems begin appearing. This is why investors should continue watching how efficiently the company manages inventory, customer collections, and financing over time, not because there is evidence of a current problem, but because it is one of the key moving parts of this business model. Now let's talk about another invisible challenge. Imagine you're selling imported chocolate. Everything is going well. Then suddenly, the value of the rupee changes sharply. Overnight, your imported products become more expensive. You didn't make a mistake. The market simply changed around you. Redington operates in a business connected to global technology brands and international supply chains. That means movements in currencies, global demand, shipping costs, and international trade conditions can all influence day-to-day operations. Think of a fisherman. Even the most experienced fisherman cannot control the sea. He can only learn to navigate it better than others. Now here's another question. What happens when technology changes? At first, that sounds like wonderful news. After all, technology companies benefit from innovation. Yes, but only if they keep adapting. Imagine opening a video rental shop just before streaming platforms arrive. Your business didn't fail because you were lazy. The world simply changed. The lesson is simple. No company can afford to become comfortable. One generation of technology replaces another. Customers change. Businesses evolve. New products appear. Old products disappear. A company like Redington must constantly evolve alongside the technology ecosystem it serves. Standing still is not an option. Let's talk about competition. Imagine opening the most successful restaurant in town. Soon, other restaurants appear nearby. Some lower prices. Some offer discounts. Some introduce new menus. Success attracts competition. Business history has repeated this lesson for centuries. Good businesses invite competitors. Great businesses survive them. That is why investors shouldn't simply ask, "Can competitors enter?" Instead ask, "Can competitors easily replace decades of relationships, execution, trust, and operational excellence?" There is an enormous difference between entering a market and becoming indispensable within it. Now let's discuss another psychological trap. Imagine a student who scores 95 marks every year. One year, the student scores 92. Objectively, 92 is an excellent score. But everyone feels disappointed. Why? Because expectations changed. Markets behave exactly the same way. Sometimes companies continue performing well, yet their stock prices fall. Not because the business became worse, but because investors expected perfection. Howard Marks often reminds us, risk isn't only about bad companies. Risk also comes from expectations becoming too optimistic. The higher expectations climb, the harder they become to satisfy. That's why successful investors keep asking, what is already expected? Instead of only asking, how good is the company? Now imagine driving a luxury car. The engine is powerful. The road is smooth. Everything feels effortless. That's exactly when experienced drivers become most alert. Because confidence can quietly become overconfidence. Markets behave similarly. When every headline is positive, every chart looks attractive, and everyone suddenly agrees. That's often the moment disciplined investors become more careful. Not because the company is bad, but because emotions can temporarily run ahead of reality. Discipline matters most when confidence is highest. This brings us to another beautiful mental model. Imagine climbing Mount Everest. Reaching the summit feels incredible. But experienced climbers will tell you something surprising. The most dangerous part of the journey is often coming down. Why? Because success creates confidence. Confidence sometimes reduces caution. Investing follows the same pattern. A rising stock deserves appreciation. It also deserves continuous verification. Every new quarterly result should answer one simple question. Is the original investment story becoming stronger or weaker? Never fall in love with a stock. Fall in love with evidence. Evidence changes. Opinions should change with it. Now let's imagine two investors. The first says, "This company can never fail." The second says, "This company has strengths, but I know exactly what I'm watching for." Which investor do you think survives longer? Almost always the second one. Because humility protects capital. Certainty often destroys it. The market has a unique way of reminding everyone that no business, no management, and no investor is bigger than reality. So, after studying Redington, What should we really conclude? Not that it is risk-free. No business is. Not that success is guaranteed. It never is. Instead, we should conclude that the company currently presents a story where improving fundamentals, management continuity, industry tailwinds, and supportive market behavior appear stronger than the key risks we've discussed. But that conclusion isn't permanent. It's a hypothesis. And every quarter, the market conducts another examination. Great investors don't marry their hypotheses. They update them. Story behind stocks. Because protecting your capital is just as important as growing it. The best investors don't ignore risks. They understand them before the market does. Now, only one chapter remains. Not about financial statements. Not about valuation. Not about charts. Not even about Redington alone. Instead, we'll answer the biggest question every investor eventually faces. What kind of investor should even consider studying a business like this? Is it suitable for someone seeking quick excitement? Or does it reward patience? What is the biggest lesson this company teaches us about investing itself? And perhaps most importantly, if you forget every number we've discussed today, what is the one idea you should remember years from now whenever you evaluate any company? Because in the end, great investing isn't about memorizing ratios. It's about building a way of thinking that stays with you for life. Before we move into the final chapter, I'd genuinely love to hear your perspective. Looking back across the entire journey so far, which chapter challenged the way you think about investing the most? And if there's a chapter that you believe could be even more engaging or easier to understand, tell me in the comments. Your feedback helps every future story behind stocks become even better. Chapter 09, Beyond Redington. The biggest investment you make isn't in a stock. It's in the way you think. Let me ask you one final question. Imagine I gave to people exactly the same cricket bat, the same pitch, the same weather, the same opponent. Would both players score a century? Of course not, because success doesn't come from the bat. It comes from the person holding it. The stock market is remarkably similar. Thousands of investors can study the same company, read the same annual report, listen to the same management conference call, observe the same chart. Yet after 5 years, their results are completely different. Why? Because investing isn't only about choosing companies. It's about building judgment. And that's exactly why today's story was never just about Redington. It was about learning how to think. Welcome back. And welcome to the final chapter of Story Behind Stocks, where we don't just study companies. We uncover the business stories hiding behind stock prices. When we started this journey, Redington looked like a simple technology distributor. Almost boring. No dramatic headlines. No glamorous products carrying its own logo. No celebrity founder dominating social media. Just another company quietly doing business. Or so it seemed. But then, we started asking better questions. Not, what does this company sell? But, what problem does this company solve? That one question changed everything. Because the company wasn't selling boxes. It was moving an entire digital economy. It wasn't merely transporting products. It was connecting global technology companies with millions of businesses and consumers. The business looked ordinary. Its role was extraordinary. Then we traveled into the sector itself. And something became obvious. India's digital transformation isn't a one-year story. Artificial intelligence, cloud computing, cybersecurity, enterprise software, digital banking, smart manufacturing, healthcare technology, connected classrooms. These are not temporary trends. These are structural shifts. Imagine planting a mango tree. You don't expect fruit tomorrow. But if the climate remains favorable, the tree keeps growing. Technology adoption is that climate. Companies serving this ecosystem have the opportunity to grow alongside it. Not because growth is guaranteed, but because the environment itself continues expanding. Then we met the management. And we discovered something experienced investors already know. Products create revenue. Management creates longevity. A company may have wonderful opportunities, but without disciplined execution, those opportunities disappear. What impressed us wasn't one spectacular announcement. It was consistency, continuity, the willingness to build patiently instead of chasing headlines. Business history repeatedly teaches us that wealth is rarely created by dramatic moments. It is created through thousands of disciplined decisions repeated over many years. Then we opened the financial statements, and suddenly, the story became measurable. Revenue wasn't merely increasing. The business itself was becoming larger. Profits weren't simply growing. The company appeared to be converting growth into stronger shareholder earnings. The balance sheet continued strengthening. Shareholder earnings improved. The company continued rewarding investors through dividends. Were there challenges? Absolutely. Working capital requires continuous attention. Finance costs deserve monitoring. Competition never sleeps. Technology keeps evolving. But investing has never been about finding businesses without problems. It's about finding businesses whose strengths appear to be improving faster than their challenges. Then we stepped into valuation and perhaps discovered the biggest lesson of all. Cheap is not the same as valuable. Imagine buying a luxury watch for 5,000 rupees. It sounds cheap until you discover it stops working after 3 weeks. Now imagine buying a quality watch for 25,000 rupees that lasts 20 years. Which one was actually cheaper? The same logic applies to businesses. Quality matters. Growth matters. Management matters. Capital allocation matters. Reasonable valuation matters. Great investments are rarely born from low prices alone. They're born when quality and value meet each other. Then we entered the fascinating world of charts. Not as fortune tellers, but as students of human behavior. We realized something profound. Charts don't predict tomorrow. People create charts. Fear creates charts. Greed creates charts. Hope creates charts. Patience creates charts. Institutions create charts. Retail investors create charts. Every candle, every trend, every pause represents millions of decisions made by human beings. And suddenly, technical analysis stopped looking like mathematics. It started looking like psychology. Then we connected every piece together. Business, industry, management, financials, valuation, market behavior. Each was only one puzzle piece. But together, they began forming one coherent picture. That is exactly how professional investing works. Nobody invests because one ratio looks attractive. Nobody invests because one chart looks beautiful. Nobody invests because one quarter looks impressive. Conviction isn't built in a day. It is built when independent evidence begins agreeing with each other. Think of a courtroom. A judge rarely announces a verdict after hearing one witness. The decision comes after listening to many independent witnesses. Investing should work exactly the same way. Now let me share one of my favorite mental models. Imagine a pilot preparing for takeoff. Before every flight, the pilot follows a checklist. Fuel, engine, weather, navigation, communication, emergency systems, thousands of flights. The same checklist. Because professionals trust systems, not emotions. Now imagine investing the same way. Before starting any company, you quietly ask yourself, is the industry growing? Does the company solve an important problem? Can management be trusted? Are earnings improving? Is capital being allocated wisely? Does valuation make sense? Is market behavior supporting the business story? Where are the biggest risks? Notice something interesting. Not a single question asks, will this stock double next month? Because professionals know. Nobody can answer that. The right questions produce better decisions. The wrong questions produce better guesses. Peter Lynch once said, know what you own and know why you own it. Such a simple sentence. Yet it contains an entire investing philosophy. Imagine waking up tomorrow morning and the stock market falls sharply. News channels become noisy. Social media turns fearful. Prices flash red everywhere. What will you do? If your only reason for buying was someone recommended it, you'll probably panic. But if you understand the business, the industry, the management, the valuation, the risks, and the opportunity, you'll respond very differently. Knowledge doesn't remove volatility. It removes unnecessary fear. Howard Marks often says, the goal isn't to be right every time. The goal is to make better decisions than the average participant over long periods. Notice the humility in that statement. No mention of certainty. No promise of perfection. Just probability. That's how investing really works. Not by predicting every outcome, but by repeatedly placing yourself where the odds appear favorable. Now let's answer the question many of you have probably been waiting for. What kind of investor might find a company like Redington worth studying? Certainly not someone searching for overnight excitement. Markets have plenty of stories promising instant riches. Most disappear as quickly as they arrive. Instead, this appears to be the kind of business that may attract investors who appreciate patience, people who enjoy understanding businesses, people who value improving earnings over exciting headlines, people who believe quality businesses deserve attention even when they don't dominate daily conversations, people who understand that wealth is often created quietly, long before newspapers begin writing about it. And perhaps that's the biggest lesson Redington teaches us. Sometimes, the market hides extraordinary businesses inside ordinary-looking companies. Not every company with a glamorous story creates wealth, and not every company with a quiet story deserves to be ignored. The real opportunity often lies in asking questions others never thought to ask. Now, before we end, I'd like to leave you with one final thought. Imagine two libraries. One is filled with books about stock tips. The other is filled with books about business. Which library do you think produces better investors after 20 years? Almost certainly the second one, because stock tips expire. Business understanding compounds. That's why this channel was never created to tell you what to buy. It was created to help you understand why businesses become valuable. If that understanding improves, better investment decisions naturally follow. Story behind stocks. Because every stock has a story. But only those who understand the story truly understand the investment. As we close this journey, remember something important. This entire discussion is not a buy recommendation. It is not a sell recommendation. It is simply a framework for thinking. The purpose of this series is not to replace your research. It is to improve your research. Every company deserves continuous study. Every investment thesis deserves regular review. Every quarter brings new evidence. Great investors don't defend old opinions. They update them. Because the market rewards learning, not ego. And now, before you leave, I have one small request. You've traveled through every chapter of this story with me. So tell me honestly, which chapter stayed with you the longest? Was it the hidden business model? The sector story? The management philosophy? The financial detective work? The valuation journey? The psychology behind charts? The investment mosaic? Or the discussion about risks? And more importantly, which chapter do you feel could become even better?